The financial markets have existed for centuries, yet the same story repeats itself again and again. Every generation believes it has discovered something new, some shortcut, some secret formula that will finally make trading easy. New technology appears, charts become more colorful, platforms become faster, and information becomes cheaper. But despite all these changes, one fact remains painfully consistent. The majority of traders lose money. Studies, brokers, and historical records all point to the same conclusion. Around 90% of traders fail. This number is not accidental, it is not temporary, it is structural. And Jesse Livermore understood exactly why. Jesse Livermore was not just a trader, he was a student of human behavior. He watched crowds, price movements, panic, euphoria, and repetition. What he discovered was simple, yet brutal. The market does not defeat traders, traders defeat themselves. Human nature, not market complexity, is the true enemy. Fear, greed, impatience, and ego quietly destroy accounts one trade at a time. Most traders begin their journey with the wrong question. They ask, "How much can I make?" instead of asking, "How much can I lose?" This single mistake sets them on a path toward failure. Trading is a game of survival before it is a game of profit. Jesse Livermore believed that capital preservation was sacred. Without capital, there is no opportunity, no recovery, and no future in the markets. Yet most traders treat risk as an afterthought, something to be considered only once profits disappear. One of the most common and deadly mistakes traders make is risking too much on a single trade. Beginners often believe that confidence means taking large positions. They think bigger size equals bigger success. In reality, it equals bigger vulnerability. One unexpected move, one piece of news, one spike in volatility, and the account is permanently damaged. Livermore warned that the market can stay irrational longer than a trader can stay solvent. This is not philosophy, it is a survival law. Another reason most traders fail is impatience. They want results immediately. They want action every day. When the market is quiet, they feel uncomfortable. When price is moving sideways, they force trades that have no real edge. Livermore understood that waiting was not weakness. It was strength. He believed that real money was made by sitting through the right trades, not by constantly jumping in and out of the market. The biggest moves often come after long periods of boredom, and only patient traders are present to benefit from them. Overtrading slowly kills accounts. Each trade feels harmless on its own, but together they create a steady drain. Consider the emotional cost, decision fatigue, stress, frustration, and loss of focus. Consider the financial cost, spreads, commissions, slippage, and small repeated losses. Over time, discipline breaks down, and trading turns into gambling. Livermore knew that activity does not equal productivity. Sometimes, the smartest trade is no trade at all. Fear plays a powerful role in the failure of most traders. Fear causes traders to cut their winners short. The moment a trade shows profit, fear whispers that it might disappear. So they exit early, locking in small gains. At the same time, fear prevents them from accepting losses quickly. They hesitate, hoping the market will turn. This creates a destructive imbalance, small wins and large losses. Over time, this guarantees failure. Greed is fear's mirror image, and it is just as dangerous. When traders experience success, greed convinces them that the rules no longer apply. Risk increases. Position sizes grow. Stop losses are moved or removed entirely. What begins as confidence turns into arrogance. Jesse Livermore himself suffered from this flaw during different periods of his life, proving that even the greatest traders are vulnerable when discipline fades. Another critical mistake is the need to be right. Many traders tie their identity to their opinions. A losing trade feels like a personal attack. Instead of exiting when the trade is invalidated, they hold on, adding to losing positions, convincing themselves that the market is wrong. Livermore believed this mindset was fatal. The market does not care who you are, how smart you are, or how strongly you believe. It rewards only those who respond correctly to price. Most traders also fail because they rely blindly on indicators and systems. They search endlessly for the perfect setup, the holy grail, the one strategy that never fails. Livermore understood that no system works in all conditions. Markets evolve, volatility changes, and behavior shifts. Tools can help, but they cannot replace judgment. Understanding price behavior and crowd psychology is far more important than any indicator. Another overlooked reason traders fail is the lack of self-review. They do not journal their trades. They do not analyze mistakes. They repeat the same errors without realizing it. Livermore believed that LF knowledge was essential. Every loss carries information, every mistake offers a lesson. But only traders who accept responsibility can learn from them. Blame is poison. Traders blame brokers, institutions, news, algorithms, and manipulation. While markets are not perfect, blaming external forces prevents growth. Livermore believed that responsibility was power. When you accept that your decisions created your results, you gain the ability to change them. The truth about trading is uncomfortable. It requires patience in a world addicted to speed. It requires discipline in a culture driven by excitement. It requires emotional control in an environment designed to provoke emotion. This is why most traders fail, not because success is impossible, but because mastery of self is rare. Jesse Livermore's lessons remain as relevant today as they were a century ago. Control risk before chasing reward. Wait for the right opportunities. Cut losses quickly and without emotion. Let winners run. Respect the market at all times. Those who ignore these principles will continue to become part of the 90%. Those who embrace them may finally step beyond survival and into consistency. Trading is often misunderstood as a technical skill or a game of intelligence. Charts, indicators, systems, algorithms, and strategies dominate conversations among traders. Yet the most important aspect of trading is almost always ignored: the human mind. Trading is psychological first, technical second. Every single decision a trader makes is filtered through emotions, biases, fears, and desires. And it is these mental filters that determine success or failure far more than any chart pattern or indicator ever could. Jesse Livermore, the legendary trader, understood this better than most. He knew that mastering the mind was not optional. It was the prerequisite for survival in the markets. The first mental obstacle every trader faces is fear. Fear manifests in many forms, often subtly, almost invisibly. Fear of losing money makes traders hesitant to enter good trades. They wait for perfection that never comes, missing opportunities that would have rewarded patience and discipline. Fear also causes traders to exit winning trades prematurely. The moment a position becomes profitable, the mind begins to whisper warnings. What if it reverses? What if you lose your gains? And so, traders lock in small profits while allowing larger losses to grow unchecked. Over time, fear quietly destroys accounts, one hesitant trade at a time. Greed is the twin of fear, equally powerful and equally destructive. Greed convinces traders to hold positions far longer than logic allows. It inflates expectations, inflates confidence, and often erases weeks of disciplined effort in a single session. A winning trade becomes a source of temptation rather than a tool of compounding. Jesse Livermore observed this cycle repeatedly. Traders would chase profits, ignore stop losses, and hope for miraculous extensions, only to be humbled when the market inevitably corrected. Greed turns strategy into speculation, planning into improvisation, and skill into luck. Another psychological trap is overconfidence. A string of successful trades can deceive traders into believing they have mastered the market. They start taking excessive risk, breaking their own rules and overestimating their abilities. Overconfidence leads to mistakes that are often catastrophic. Livermore's life itself was a testament to this lesson. Periods of great wealth were often followed by devastating losses, driven not by the market but by human hubris. Markets do not care about your history of wins. They only react to price and human behavior. In the present, impatience is perhaps the most overlooked psychological flaw. Modern trading platforms, instant news feeds, and real-time price updates condition traders to expect constant action. They want trades every day. They want profits every hour. When the market does not move according to their expectations, they force trades. They chase setups that are not truly favorable, convincing themselves that this time will be different. Jesse Livermore understood that patience was not a passive state. It was an active discipline. He often sat for hours, days, and sometimes weeks, waiting for perfect conditions to unfold. Profits came not to those who were constantly active, but to those who waited for opportunity. Revenge trading is a dangerous psychological habit that destroys accounts faster than almost anything else. After a loss, emotional turbulence rises. Traders want to recover immediately. They increase their position sizes, abandon strategies, and chase the market impulsively. This desperation almost always results in deeper losses. Livermore observed that losses are part of trading, but how a trader responds determines their survival. Calm, structured reactions preserve capital. Emotional reactions destroy it. Many traders fail because they cannot separate themselves from the outcome. Every loss becomes personal. Every missed opportunity feels like failure. This inability to remain objective distorts decision-making. Professional traders understand that a trade is not a reflection of personal intelligence or worth. It is simply a moment in time, with probabilities and risks that must be respected. Detachment allows traders to execute plans consistently, regardless of short-term emotional discomfort. Mental fatigue is another killer. Trading is not just about understanding markets, it is about maintaining clarity under constant pressure. After several trades, even disciplined individuals can become emotionally exhausted. Judgment falters. Rules are forgotten. Patience gives way to impulsive decisions. Professional traders limit the number of trades they take, the hours they operate, and the markets they engage with. They recognize that clarity is a finite resource, and that decisions made under fatigue are often dangerous. Traders also fail because they seek validation. They equate constant activity with skill, believing that being busy proves competence. This compulsion to act leads to overtrading and self-sabotage. In reality, true skill is demonstrated in restraint, in the ability to do nothing when conditions are unfavorable. Jesse Livermore often emphasized that the correct trade is sometimes no trade at all. Inaction, when disciplined, is a powerful weapon. Journaling and self-analysis are essential, yet often ignored. Traders who fail rarely review their actions objectively. They do not ask why a trade went wrong or what psychological factors influenced it. Without self-awareness, the same mistakes are repeated endlessly. Livermore believed that reflection was critical. Every mistake contains a lesson, every loss a potential insight, but only if the trader is willing to see it. Responsibility is empowering, blame is destructive. Traders who blame external forces, brokers, news, or algorithms refuse to learn and therefore remain trapped in repeated failure. The psychology of winning is as subtle as the psychology of losing. Profitable traders do not always win on every trade. They win in the aggregate. They understand probabilities. They manage risk meticulously. They let their winners run and cut their losses swiftly. Above all, they maintain emotional equilibrium. Success is not about predicting the future with certainty. It is about maintaining consistency, discipline, and calmness under uncertainty. Education and knowledge are helpful, but insufficient. Many traders spend years studying charts, indicators, and strategies without ever achieving real success. Intelligence alone cannot conquer fear or greed. Knowledge without emotional control is an unstable foundation. Jesse Livermore repeatedly warned that the human element, the trader's own mind, is the battlefield on which success or failure is decided. Finally, trading requires humility. Markets are powerful, unpredictable, and indifferent. No one can control them. Humility allows a trader to accept that losses are inevitable, that no one is right all the time, and that rules exist to protect capital rather than satisfy ego. Pride leads traders to ignore stops, bend rules, and rationalize losses, while humility reinforces discipline, patience, and structure. In conclusion, the psychology of trading is the primary determinant of success. Fear, greed, impatience, overconfidence, revenge, mental fatigue, and the compulsion for validation quietly destroy accounts every day. Mastery of self is the only reliable path to survival and long-term profitability. Jesse Livermore's principles are timeless. Act with discipline, respect probabilities, cut losses quickly, let winners run, maintain patience, and above all, understand that trading is a reflection of your own mind. Those who ignore these lessons will continue to fail. Those who embrace them may finally step beyond the 90% and into consistency, control, and long-term success. The world of trading, most beginners focus obsessively on profits, on strategies, and on timing. They chase the idea of winning trades, the thrill of the market, and the excitement of making money fast. But professionals understand a profound truth. Success is not determined by how much you make, but by how well you manage risk. Risk management is the silent weapon that separates consistent winners from the 90% who fail. It is the foundation upon which all profitable trading is built, yet it is the aspect of trading that is most often ignored, misunderstood, or dismissed by beginners. Jesse Livermore, one of the greatest traders in history, repeatedly emphasized that capital preservation comes before all else. Without capital, there is no opportunity to learn, to adapt, or to profit. Beginners often treat losses as temporary setbacks, hoping to recover with the next trade, often taking even larger risks in the process. This is a dangerous illusion. Professionals treat losses as inevitable, probabilistic outcomes, and they prepare for them with strict rules and disciplined risk controls. They know that one catastrophic trade can wipe out years of effort, regardless of skill or intelligence. The first principle of risk management is position sizing. How much you allocate to a single trade determines the magnitude of potential loss. Professionals rarely risk more than a small percentage of their capital on any one trade, often between 1 and 2%. This ensures that no single trade can threaten their survival. Position sizing may seem simple, but it is a tool that has saved countless traders from emotional decisions and catastrophic losses. It forces discipline, reduces stress, and allows rational analysis to guide actions rather than fear or greed. Stop losses are another cornerstone of professional risk management. Refusing to use them is akin to gambling. Traders who ignore stop losses may justify it as flexibility or belief in their skill, but markets do not bend to anyone's ego. A stop loss is not a sign of weakness, it is a commitment to survival. It enforces rules when emotions threaten to override logic. Professional traders understand that a loss is not failure. If it is within their plan, uncontrolled loss is true failure. Livermore understood this principle intuitively, accepting small losses without hesitation to protect capital for the next opportunity. Asymmetric risk-reward ratios are equally critical. Professionals do not trade blindly. They look for setups where potential reward significantly outweighs potential risk. Even with a low win rate, this approach allows profits to accumulate over time. Beginners often ignore this principle, focusing on winning percentages rather than the size of winners versus losers. They may have a high win rate but still fail because a single loss erases multiple small gains. Understanding and exploiting asymmetry is a key differentiator between the disciplined professional and the emotionally reactive amateur. Diversification and correlation awareness are also part of intelligent risk management. Overexposure to a single market, sector, or correlated asset can destroy accounts in an instant. Professionals spread their risk intelligently, recognizing that true protection comes not from random allocation, but from strategic distribution across instruments with low correlation. They avoid creating hidden systemic risks, understanding that diversification is a hedge against volatility and unexpected market events. Perhaps the most overlooked aspect of risk management is the ability to do nothing. Markets are often quiet, sideways, or uncertain. Beginners feel compelled to act at every opportunity, mistaking activity for progress. Professionals understand that sometimes the best decision is no decision at all. By sitting out when conditions are unfavorable, they preserve capital and avoid unnecessary losses. Livermore's greatest profits often came after long periods of patient observation, not constant trading. Discipline to wait is a powerful, often underestimated tool. Mental preparation is another element of professional risk management. Traders must manage not just the numbers, but their own psychology. Emotional control, awareness of biases, and realistic expectations are critical to survival. Professionals anticipate stress, fatigue, and fear, and they implement routines to mitigate their effects. Trading plans, journals, and predefined risk limits act as safeguards against impulsive decisions. A disciplined mind is a shield as essential as any stop-loss or position size calculation. Risk management extends beyond individual trades to the overall portfolio. Professionals track cumulative exposure, account for volatility, and calculate worst-case scenarios. They continuously reassess risk in real time, adjusting positions as conditions evolve. Beginners often ignore these dynamic aspects, treating each trade as isolated, which leaves them vulnerable to compounding losses during market turbulence. The irony of trading is that those who focus on risk often make more money over time than those who chase profits. The market is probabilistic, not deterministic. No strategy works every time. Survival and consistency allow probabilities to play out in your favor. Professionals accept that losses are part of the process, while amateurs treat them as catastrophes by managing risk. First, professionals ensure they remain in the game long enough for opportunity to compound in their favor. Technology has made risk management both easier and more critical. Modern platforms allow precise position sizing, automated stop losses, real-time correlation analysis, and portfolio monitoring. Yet technology alone does not enforce discipline. The trader must still follow the rules. Automation can execute, but it cannot feel fear, greed, or impatience, emotions that ruin accounts if the rules are ignored. Livermore's life is a testament to these principles. Even a man capable of enormous profits suffered immense losses when risk management failed or when emotional control broke down. His successes were amplified by discipline and patience. His failures were magnified by hubris and impulsivity. The lesson is clear: capital, protection, disciplined sizing, strict stops, and emotional mastery are non-negotiable. In modern markets, risk management is even more crucial. Leverage allows for enormous positions with minimal capital, amplifying both gains and losses. Volatility is higher, news travels instantly, and herd behavior can move markets faster than ever. Professionals respect these realities. They approach leverage cautiously, size positions prudently, and always plan for the worst-case scenario. The amateur, seduced by the promise of large profits, often finds themselves wiped out by a single unexpected move. Another advanced aspect is contingency planning. Professionals do not just rely on predefined stop losses. They plan for black swan events, flash crashes, liquidity gaps, and unexpected geopolitical developments. They know that the market is indifferent to human preparation. Risk management is not a passive defense. It is a proactive strategy that anticipates failure, mitigates loss, and positions the trader to take advantage when conditions improve. Finally, risk management is a mindset, not a set of rules. Professionals think probabilistically, accept uncertainty, and maintain humility. They understand that no trade, no strategy, and no market condition guarantees success. Control is exercised not by forcing outcomes, but by controlling exposure, maintaining discipline, and surviving to trade another day. Jesse Livermore repeatedly emphasized that survival is the foundation of profit, and risk management is the instrument that ensures it. In conclusion, risk management is the silent weapon of successful traders. Position sizing, stop-loss discipline, asymmetric risk-reward evaluatio, diversification, portfolio oversight, mental preparation, and contingency planning collectively create a framework that protects capital and allows opportunity to compound. Those who ignore these principles, no matter how clever or skilled, are destined to become part of the 90% who fail. Those who master risk management, however, create the conditions for consistency, longevity, and eventual success. In the markets, survival is the ultimate strategy, and risk management is its most powerful tool. Without it, no system, no indicator, and no strategy can save a trader from the inevitable consequences of unchecked fear, greed, and impatience.